Hey, welcome back everyone. In this section of the course, I'm going to be teaching you how the Fibonacci strategy actually works. But before we get to the video, check the link in the description for the full course and get 50% off if you use the top link. And to start, the Fibonacci strategy is broken down into three main parts. We have market structure, and as you may know based off of watching my previous videos, market structure have to do with the general direction of price. Whether price is either going up in an uptrend or coming down in a downtrend. In an uptrend, you want to look for both higher highs and higher lows. Let me label it here. As you can see in this example that I drew out, price is forming higher highs here and it's also forming higher lows as you may see here. In a downtrend now, price you want to look for price to form both lower highs as you see here, and you want price to form lower lows. As you may see here again. And just to clear up any confusion, HH stands for higher highs, HL stands for higher lows, LH stands for lower highs, and LL stands for lower lows. So this is what you want, this is what you look for. And there's also a third one, which I like to call consolidation. It happens when prices neither going up or coming down. It's moving side to side in a consolidation, something like this, where prices neither forming higher highs nor higher lows, just moving side to side. But there's no need to remember this right now, as the strategy does not uses it. I think I'll have all of this in my market structure video. Okay. Now going down to the second part of the strategy, which is the entry. And I use two entries. I'm going to be teaching two of them in this course. But in this video, I'm only going to be explaining the indicator entry. And for this entry, I use both the MACD and exponential moving averages. I use them both together. So for the EMAs, we have the 20 EMA, which is the red one here, and we have the 10 EMA, or the 10 exponential moving average, which is the blue one. And in a downtrend, I look for price to cross. I look for the 20 or the red exponential moving average to cross above the 10 or the blue exponential moving average for a down entry or selling entry. Along with that, I look for price. Now I look for the EMA, which is the blue line, the EMA line, the blue line on the default settings of the MACD on Tradingview. I look for that to cross below the 0 point on the MACD. And just like I explained in my previous video, the 0 point is this point right here. Okay, I'll make it thicker. This is 0 point. So I look for both the the EMA cross and the MACD line to drop below the 0 point on the MACD chart, on the MACD. sorry. And the last one now, the last part of the strategy is risk management, which I'll get to later down. Okay, now to explain the strategy, the first thing you need to do is to identify market structure. And let's just use this example here. Let's imagine that price is going up in an uptrend. How the strategy works is that we look for impulse moves in the general direction of price or in an uptrend or downtrend. And if you're wondering what impulse moves are these big moves. I'll make this red. Impulse moves are these big moves that happens or that goes in the general direction of price. So like if price is going down, the impulse moves will be the big moves pushing price down. And if price is going up, the impulse moves will be these big moves that push price up to form the higher highs and the higher lows. And the opposite on the downtrend. The impulse moves will be these big moves here that push price down in the general direction of the trend, or in the direction of the trend. So let's imagine that price is going up here. Make this bigger. Okay, let's imagine the price is going up. How this strategy works is that we draw a Fibonacci from the beginning of the impulse move to the end of the impulse move on the daily time frame. We start off on the daily time frame. So let's imagine price is going up here and we have this big impulse move. After the formation of the impulse move, we draw a fib, but once we see price starting to retrace and or pull back down, we draw a fib from the beginning of the impulse move here all the way up to the end of the impulse move, like this. Then we wait for price to fall or price to drop or pull back to one of these points right here, one of these 4 points. We want price to fall back to either the 0.382 or the 0.5 or the 0.618 or the 0.786. We want price to fall back to one of these points. If price fails to fall back to one of these points or drops below, like for example, if price drops far below where we started off or where the impulse move started off, forming a lower low or breaking the structure of price, we do not take the trade. And if price fail to fall back to at least the 0.382 point, like let's say price dropped down to like right above here before going up back, we do not take the trade. So those two things, where price falls far below the beginning of the impulse move or far above the beginning of the impulse move, or if price fails to fall to at least the 0.382 point, in these two cases we do not take the trade. But if price comes down and bounces off of one of these points, the next thing we need to do is to switch from the daily time frame to the 4-hour time frame. And on the 4-hour time frame now, here is where we look for our entry in an uptrend like this, after we finish switching and going down to the 4-hour time frame. Since price is retracing back down, we expect that the MACD line should be alright. So we expect that the MACD line should be above the 0 point. It should be above, we expect the MACD line a line here to be below the 0 point, because price is retracing downwards or retracing back in an option here in this example. So we expect the MACD line to be below the 0 point. So once no, and we expect again for the red EMA or the red exponential moving average or the 20 exponential moving average to be above. Let's try and draw it out. We expect, let's imagine that this is the 20 exponential moving average. We expect that to be above the 10 exponential moving average, like this. This is what we expect. Right? So this is what we expect the EMA to look like. The 20 exponential moving average of the red to be above the 10 exponential moving average, and the MACD line, we expect that to be below the 0 point on the MACD. Now, in order to enter the trade now, we want everything to switch. So what we want both of these to be true. We want the MACD line to cross above the 0 point on the MACD, and we want the EMAs to cross. So we want the 10 exponential moving average to cross above the 20 exponential moving average. So once both of those are true, then we enter the trade. At the very point that both of those are true, we enter the trade, placing our stop loss. Let's say we enter the trade a long position right here. We place our stop loss, either we place it at the 0.618 like this for a very safe trade, or if it's a case where, for example, the 0.618 is too far, so the stop loss will be too big, we place the stop loss right below the previous low or the end of the retracement like this. Just like this. In other cases now, if you're able to put your stop loss at the 0.786 point with a like a stop loss that is below 150 pips, you place it. The 0.786 is just to be very safe, but I recommend that you place it at the 0.618. Well, let's say that price came down instead of up here. Let's say price came down and bounced off of the 0. Let's get rid of this. It can bounce off of this 0.786 point. Let's say price came down and bounced off of this. Well, your stop loss now, so you entered here, your stop loss will be either below the previous, the end of the retracement or the previous low right here, or your stop loss will be below the beginning of the impulse move that we traded off of. One of the two. If it's a case where price comes down and bounces off of the 0.618, then your stop loss will then either go below the end of the retracement here or the previous low, or at the 0.786 point right here. So that's how we trade, and we look for these on a daily basis. So you open the market every day. You may not get a trade every day. I'll have a video dedicated to how you can get a trade every day using this strategy right here on the lower time frame, because this very strategy works on all time frames. So I have a video on that. Oh yeah, and let's say you enter the trade right here and you place your stop loss right below the previous low or the end of the retracement. how we trade is that we place our take profit at the wrong number, or the psychological number below below the negative 0.272 point. So let's say like for example, the wrong number below this point right here right now is the 50. That's the very first wrong number below it. So that will be our take profit. But if it's a case where your take profit is below, or your win rate on the trade is below a 1 to 3, once you place your take profit at the wrong number below the negative 2.72, if it's a case where that happened, then you just adjust your take profit. So it can be, so let's say example, something like this, and your take profit at the very first wrong number below this point is not a 1 to 3 risk to reward ratio. If this is that case, then you adjust it a bit to be at least a 1 to 3 risk to reward ratio, at least. And in this case, it's at our negative 0.618. But it doesn't matter if it's up here, far above, doesn't matter. Once it's a 1 to 3 risk to reward ratio, you place it. And in every case, a 1 to 3 risk to reward ratio should be the lowest trade you take. That should be the absolute lowest. If you're looking to take a bit more risk, you can go for a 1 to 6 risk to reward ratio. Or if you're feeling bold, you can even go for 1 to 10 risk to reward ratio, if you feel that you got a good position. And if you're doing this, make sure to take off at least 75% of your trade and leave the rest 25% to run for a 1 to 10 or so. That's what I recommend. Okay. On the downtrend, it's this very same thing, only the opposite way. So if you're drawing your fib, let's get rid of these. If you're drawing your fib on a downtrend, remember to go to the daily time frame first. You draw your fib from the top of the impulse move all the way down to the bottom of the impulse move, like this. Then you wait for price to retrace back to one of your points, like this. Then you switch to the 4-hour time frame, and then you look for an entry using the MACD along with the crossover of the exponential moving averages for your entry. Placing your stop loss above the previous high or at one of your points, either the 0.618 or the 0.786. if price managed to retrace back to your 0.618, then your stop loss should be at your 0.786 point. If it's a case again where price retrace back to your 0.786 point, like this, your stop loss should either be above the previous high or above the beginning of the impulse move, like this, for at least a 1 to 3 risk to reward ratio, or the very first wrong number before you get to your negative 0.272 point on your Fibonacci. So in this case right here, the very first wrong number before it is the 80 wrong number, like this. So your take profit will be somewhere along here. in this case for a 1:6 risk to reward ratio. Okay, now let's get into some chart examples. Let's go back a bit. Sorry again. Let's look at this. As you can see here, price is clearly coming down. So the first thing you need to do, go to the daily time frame. We're already on the daily time frame. You look for market structure. So as you can see right here, price came down to form a low, came up to form a lower high, dropped down again all the way down here to form a lower low, came up again to form a lower high, and then dropped down, came up, dropped down. So this is our market structure right here. As you can see, price keep on forming lower lows and lower highs. So we already know we're looking for a sell. So let's say, give me a second. Okay. Okay. Okay, so let's say you saw this impulse move right here. Let's say you saw this move, and then you saw price start to retrace back up. Once you see price start to retrace up like this, the first thing you need to do, draw out your fib, starting from the very beginning of the impulse move all the way down to the bottom of the impulse move like this. Just like this. This is how you drop your fib. And if you remember what I just said a couple minutes ago, the next thing you need to do is to drop down to your 4-hour time frame. Drop down to your 4-hour time frame like this, and then you look for your entry. So at this point, price started to retrace back. So now you look for both things to be true. Since price is retracing back, the MACD line is above the 0 point. As you can see, it's above it. So now you're looking for price to, you're looking for the MACD line now to drop below the 0 point or to cross the 0 point. Also, you're looking for the exponential moving averages to cross. Both of these, you need both of these to be true. And if you look closely, you can see that the MACD line crossed the 0 point at this point right here. That's where they cross. That's where the MACD line crossed the 0. Right here. Now you look up to make sure that your 20 exponential moving average or the red exponential moving average crosses above the 10 exponential moving average or the blue exponential moving average. And in this case it did. So our entry would have been right, the entry would have been right here. And if you look closely, you can see that in this case right here, you can see in this case, price came up and bounced off of our 0.786 point. And you remember in this case now, since price bounced off of our 0.786, we place our stop loss either above the previous high, or place our stop loss above the beginning of the retracement or the impulse move, I mean. So now our stop loss is at a secure spot, which is kind of big because it's over 100 and it's over 200 pips. Could have gotten that a little bit lower to be just below 150 pips like this. Leave it at that. And our take profit would have been at the negative 0.272, but in this case it's not a 1-to-3 risk to reward ratio, so we go for the 1-to-3 risk to reward at the very least, and price came all the way down to hit it and even continue to drop. So in this case we would have profited 446 pips. Let's look for another example. Go to the daily time frame. Where was I? I was here. Okay. We just did this move right here. We just did this. So now, since price is continuing to go down, since price formed a lower low and then retraced, we then draw our fib on the impulse move again from the top to the bottom right here, just like this. Then we switch to our 4-hour time frame. Hope you're keeping up. So once we're on our 4-hour time frame, we look for our entry. And because price is retracing or pulling back, our MACD line is above the 0 point. So we're looking for the MACD line to cross below the 0 point. And in this case, it happened right here. Don't know if you can see. Zoom in a bit just to make things clearer. Okay. Sorry. Okay, should be able to see here. What? Should be able to see our MACD line cross below the 0 point right here, and it crossed on this candle right here, this very small bullish candle. And remember, the next thing we need to look for is, since we're looking for a sell, we're looking for the 20 exponential moving average, or the red exponential moving average, to be above yeah, we're looking for the sorry about that, looking for the 20 exponential moving average on the red to be above the 10 exponential moving average, and in this case we have that. So on this candle right here, both conditions for the entry have been confirmed, so we take the trade for a sell, entered at the close of the bullish candle, and since price retraced all the way back to our 0.786 again, our stop loss can either be above our previous high right here for a 70 pip stop loss, or we can be a bit more safe and set it for 90 pips, our stop loss for 90 pips, a good bit above our previous high. Or you could have also went for stop loss of 147 pips, which is above the beginning of the impulse move. But in our case, we only would have needed 74 pips for your stop loss, and our take profit all the way down to the very first wrong number above, or the very first wrong number before the negative 0.272. And in this case, the very first wrong number before it is 20. Yeah, so this would be our trade. Going for 446 pips, a 74 pip stop loss, and a 1-to-6 risk to reward ratio. So that brings us to the end of this video. Thanks for watching. Make sure to finish the course and do some practice on your own. And I'm out.